Hey everybody, welcome to the No Shill Zone. Look at who I've got right next to me. David Lin's joining us. Ben Cowen is right here as well, not in studio, but awesome. I'm so pumped to be doing this in the studio today, and it gives it a little bit of a different feel, and to have David here. David, how you doing, man?
Two of my favorite chartists and analysts. Ben, big fan of Ben's show, Into the Cryptoverse. Big fan of you, Gareth. Good to see you finally in studio.
Thank you,
You've got
man.
an amazing studio, so I'm feeling good. I'm excited to get started. How are you doing, Ben?
I'm doing great. And guys, I just want to say, if you're not, I know a lot of you guys are already subscribed to Gareth because we do the show every week, but if you're not subscribed to David, he's got a lot of great content. Make sure you go check that out. Links to his YouTube are in the description below.
Thank you.
Awesome. All right, so I'm going to kick this off to you, Ben, first, because I think of all of us, you're the most crypto savvy. Give us a rundown of what the heck is going on with Bitcoin, with alts. What are you thinking and what are you seeing?
Yeah, man. I mean, I really do think we're just in this dominance rally, and we're watching alts bleed back to Bitcoin, right? It's been going on for over 2 years now, if you think about it. And if you think about, I don't know if you can see my chart here, but if we look here at the Bitcoin dominance, it's now back above 54%, which is pretty relevant considering that I think a lot of people thought it had already topped out back in October. But I think we are getting pretty late business cycle. And at the closer we get to Fed cuts, we have to start to be open-minded to the eventual outcome that the dominance will top out, right? So again, my view right now is that a lot of the rally.
Sure, you're showing his chart when he needs you to show his chart, okay? So we're kind of working out some kinks. We don't do a lot of this stuff, but my goal is to eventually do it there. And there's the Bitcoin. There's your Bitcoin dominance chart.
Yeah. So let me just show a couple of charts here, right? So this is the dominance, and there's not a lot of metrics that have been above their 20-week SMA, 21-week EMA for the entire year, but Bitcoin dominance is one of them, right? I mean, essentially above it the entire year. Alts are bleeding back to Bitcoin. And one of my favorite charts, Gareth, we've been talking about this one for a long time. This is total 3 minus USDT divided by Bitcoin. It's almost about to break down here, right? It's really close to that breakdown point, kind of very similar to 2019. You can see that it bounced off of this area a couple times, and the third time it made it through. And you can see that it's about to make it through here again. Note, if people are curious, if you think back to 2019, Bitcoin topped out when this metric got to around 37 to 38%, right? So it's at 41% now. It just hit 40% not too long ago. So I think Bitcoin's using a lot of fuel from the altcoin market. Obviously, there's a spot ETF hype. Seems like we're going into some type of blow off top in the short term, at which point I imagine things will calm down for a while.
So David, when we look at what's going on in Bitcoin, what are you getting the sense of? Like when you have people on your show, and your show is an amazing show, the David Lin Report, is everyone bullish right now? I mean, are they all calling for 100K? I mean, obviously, I'm not necessarily, but what's the overlying theme?
First of all, no one I've interviewed is calling for 100K at least by the end of the year.
Oh, well, by end of year,
yeah,
right.
I mean, some banks, mainstream bank Standard Chartered early in the year call for 100,000 by 2024, the end of 2024. So people are starting to turn bullish that way. No one's on my show has called for $100,000 anytime soon. Their short-term outlook is not great for the most part. The longer-term outlook, like yourself, I know you're longer-term bullish on Bitcoin, but people are concerned about the coming recession, what that's going to do to risk assets. And if you consider Bitcoin trading as a risk asset, I know we'll talk about that in just a sec, that could be a problem. Bitcoin halving is happening next year. That has, as Ben can tell you more, that has historically been good for the price 6 months afterward. But it's interesting because if you consider that there's a possibility of recession next year, what's that going to do to Bitcoin? We're going to have halving and a recession.
Right.
That's never happened before. Bitcoin has never halved during a recession. So that's interesting. So no one's really completely bullish on my show. And certainly the sentiment overall is kind of muted in the crypto space based on the people I've been interviewing, even though if you consider the fact that Bitcoin's up like 130% year to date, actually more than that now, given what happened over the weekend, I mean, could you still say it's a bear market?
Yeah, I mean, I think
you still call it a.
I think for me at least, it's more like understanding that you have bigger cycles with mini cycles in them, and there's no doubt that we're in at the very least, a mini bull, if not a bigger bull. But I'm still in the camp that it's a mini bear, or mini bull. And I want to show you guys this. If we can zoom in on my charts, basically looking at a chart here of the Bitcoin longer term, right? And so there's this confluence, and let me bring up my chart here. There's a confluence of levels, and I think we've talked about this, Ben, before, is where could Bitcoin be headed before it tops out? And one of the things to take a note of here is that you actually have this level at 48,000 right here. It's the pivot top going back to April of 2022. So that was after the initial flush, the highest point of the bounce before the next flush down. And then you also have a line that goes all the way back to 2019 and connects through these lows here that were the bull market lows. So you had this kind of M top like that, and each low, it kind of connects right through. And there's a confluence right there. And then lastly, what I love to show people is that, you know, if we do go to 48, the reason why this could be such big resistance is a Fibonacci retrace here. If we take a look at this, right, and we bring this down, exactly at that same point, you know, exactly at the same point, and there's the fibs, you have this level up here, the 618 Fibonacci retrace is right at that 48 level or so. In fact, I think that's at the 42, but let me zoom back out so we can see a little bit more accurately. So, you know, listen, I don't know if it gets to 48. It's a little concerning that we're starting to see more and more people kind of predict 48. I think, you know, when I was on your show back, I talked about 12,000, 13,000, maybe 10, and then everyone else started to say the same things.
Yeah.
And then I noticed that it just doesn't happen. When everyone talks about a level, it doesn't happen. So it's a little concerning everyone's talking about this. But Ben, I guess to kick it back to you is like, you know, do you see with Bitcoin dominance increasing that it's going to push Bitcoin further up, or is it more that alts have topped out here? And I do think that's important to note, is that altcoins have not been making new highs recently. It's Bitcoin only, really.
Well, that's the big question is there a rotation into altcoins or is there not? In 2021, there was a rotation into altcoins before it came crumbling down. But in 2019, there was not a rotation into altcoins. When Bitcoin topped out, that was when altcoins topped out, even though their tops were fairly lackluster, right? And it was just, there wasn't enough liquidity. If you look at the fib retrace, by the way, in 2017, you can see that on a weekly time frame, we really didn't close much above the 0.5, which is actually where we are right now. But we did have some wicks up to the 618. So I guess that's the thing, right? I mean, you know, a lot of people are calling for 48K, so it probably means we're either not going to make it there, or we could go above it, right? That's probably what it means. But yeah, I think when it comes to altcoins and Bitcoin dominance, my view is that the dominance is likely en route to around 60%, right? And it could happen. I think it's going to get there not only on Bitcoin rallies, but also on Bitcoin drops. Well, I think we saw what happened last night. I was sleeping, but at one point, I think Bitcoin dropped like not even a whole lot. And the altcoin market dropped like 10% in like a second or something. So I think, you know, if we get a larger pullback by like that by Bitcoin, let's say it were to pull back to like the 8-week moving average or something like that. If it were to get a pullback back into the high 30s, that's where those altcoins really get flushed out. And the big question, of course, is will there be a rotation? I'm guessing that if there is a rotation, it's still a little ways out, even if there's going to be one, because normally the first couple of weeks of December are a time where Bitcoin dominance tends to go up.
Question for you. So Ben's got this really cool analytics tool on his website that organizes things into an optimal portfolio. I know you base it on a lot of metrics like Sortino and Sharpe ratio. I'm just wondering whether or not the allocation to Bitcoin changes per the dominance. So let's say dominance is at 54% right now. Let's say it gets to 60. Will your portfolio allocation to Bitcoin change just purely based on the dominance?
Yeah, so my portfolio allocation has basically been in crypto. It's been 99% Bitcoin for almost the last year and a half or so, because I just thought the Bitcoin dominance is going up. But the trick, and this is the chart you're talking about, right? So right now, the Sortino ratio is maxed out at 80% Bitcoin, 20% ETH. But this has been trending towards Bitcoin, right? I mean, I think when I was on your show, David, it was only like 70% Bitcoin. But again, the anticipation was that no, Bitcoin dominance is going to go up. We have to remember why Bitcoin dominance tops out, right? And it tops out when the Fed goes to looser monetary policy, which also happens to be in the halving year, which, by the way, happens to be an election year, which, again, there's going to be political pressure by the Federal Reserve to pivot. So my guess is that dominance is going to top out probably in the next few months. And it could be in the next month or two, but my assumption it'll be that
When,
it'll come out in the next couple of months. And as far as rotation into altcoins, normally what happens is Bitcoin dominance tops out. Then you get a flush, right? You get a flush on USD pairs, and then small caps start to outperform. I think Gareth has talked a lot about this. Like, in new secular bull markets, you would expect to see smaller cap stuff, like in stocks, right? You would expect to see like things like the Russell really moving off their lows. And we've really seen a lack of breadth this year in stocks.
Fascinating about that is that actually just the last few days, the Russell has been ripping higher. So there's definitely this kind of beginning point of chasing for what hasn't been working, right? So essentially they say it's the dash for trash, I think is the terminology. And it's not to say that all the Russell stocks are trash. I mean, there's definitely some good ones, but it's the money rotation. I mean, it's amazing. If you look at the Russell, which just this is the daily Russell, look at the size. It was up 3% on Friday. And even today, the S&P's getting crushed, the NASDAQ's getting crushed, the Russell is still positive. And again, you look at stocks like, take a look at NVIDIA today. NVIDIA is getting crushed really the last couple weeks, and yet the Russell's starting to perform. And again, I think money rotation is part of it, but I do think that, again, usually when the smaller plays go, it's towards the end of cycles versus the beginning.
Can we just talk about what's going on with Bitcoin in particular today? Because like you said, tech stocks are down. The entire NASDAQ index is down. S&P's down. The dollar is up. The 10-year is slightly up. ETH is down. Gold had a huge run up yesterday, and now it's reverting back. So gold is down. Bitcoin is the only thing on my screen that's moving up. So it's moving independently of every single other asset class that we're looking at. So I don't know why.
I would throw that to Ben. I mean, what are your thoughts on that? Why is this kind of ignoring all the rest of what's going on?
Well, if you can show my screen here, look at all these altcoins. They're all just bleeding back to Bitcoin. Like that's the reason why Bitcoin goes up, a huge reason. I think the other reason, of course, is the spot ETF stuff. But the thing that I go back to, when you think about these narratives, what often happens, think back to the merge by ETH. When did it top out against the US dollar? It topped out a month before the merge, and then it topped out against Bitcoin at the merge. I'm starting to think maybe we're going to see some type of significant top for Bitcoin here in December, and then perhaps a rally into a lower high in January where dominance goes even higher, right? And that's again what we saw last cycle. The one thing David, and I'd like to put this to Gareth too, because I really would like his input here on gold. But the one thing that I was looking back at gold last cycle and how it relates to Bitcoin, when it broke out here in June of 2019, that essentially led into Bitcoin's final blow off top for that pre-halving year, right? When gold broke out of this long window, like it had been trying to break above 1400 forever, it finally broke out. When it broke out, Bitcoin went basically parabolic into June. Alt Bitcoin pairs bled. Gold kept going up even when the Fed started to cut rates, but then Bitcoin started to fall into those rate cuts. And now I almost wonder if we're seeing the same thing happen, whereas gold looks like it's trying to break out, and in the same way, Bitcoin is breaking up and all Bitcoin pairs are bleeding. And this is also in confluence right here, where you see gold breaking out and Bitcoin going up. It's the same confluence that you're seeing right here, where total 3 minus USDT divided by Bitcoin broke down in the summer of 2019. It looks like it's about to happen again. So Gareth, my question to you is, what's going on with this gold rally? Is this a sign of risk off? Is it a sign that gold's going to keep breaking out? Because what we've seen so far is a lot of the gains that gold had last night have been retraced.
Yeah, and you're right about that. So, just taking a look at the chart on gold. So the first thing we know is that the gold level around 2080 was that, previous all-time high, right? So we had the pivot from 2020, 2022, 2023. And then really, and I want to be clear about this because there was so much hype on social media last night when gold was up $100+, but it happened right when we saw the futures open. And what happens is, number one, there's almost no volume on Sunday night, right? So the volume was dead, and it pushed above this high, which we know had probably stops. So there were probably shorts out there. Obviously, I've been a huge proponent of gold, so I think it was going to go higher, but there's a lot of people that have been doubting it, that have said, no, gold's not going to break out, and so on and so forth. And so what happens is when price breached that former level, it triggered stops, and when you trigger a stop on a short, it causes buyers, right? They have to buy that short back. And I think that's why we got this really dramatic move to the upside that probably got some buyers in there too that got excited, like, holy cow, it's mooning, as the term is, right? So I think that was it. What I think is fascinating is that not only has it given up the gains, but we're now seeing a pretty significant down day in gold. And my question is, is this just because gold has run from $1,800 all the way up to 21 and change, and it's a classic retrace? Or is there institutional involvement on trying to keep the lid on gold so it can't break out yet? I think honestly, personally, it's going to break out either way. But I do think it just maybe needs to digest the recent moves, because at least on gold, when you move from 1,800 to 21 and a half, or 21, that's a monstrous. I mean, how many times historically in a couple months have you made that type of move? Not very often, and I think it might have just been a little too much too fast.
I think I have an answer to your question as to why gold is retracing the way it is today. So we have to first of all examine why it moved up last night. So there was a attack on U.S. Navy ships by the Houthis, which is an Iranian-backed rebel group based in Yemen. So momentarily, there was a huge fear that the tensions in the Middle East would escalate. Gold trades on that fear. What we've learned over the last 2 years, though, Gareth and Ben, is that gold doesn't typically maintain its geopolitical risk premium.
Right.
We saw that during the Ukraine war. Gold was already moving up during the month prior to the invasion of Ukraine, so it was already moving up. But when the Russian forces invaded, it spiked up $150. Didn't stay that way for very long. Same thing happened before then during COVID. Fundamentals pushed it up, and what we're seeing today is the same thing. We had a one day or one night heightened era of tension that is now subsiding, and now fundamentals are taking over. Like I said earlier, the dollar is up, 10-year is up. These are things that move gold down. So what we saw last night is gold reacting to fear, and now things are coming down. We're not seeing the war escalate today, and then fundamentals are taking over today.
Yeah, that makes a lot of sense. And I think that's a great point to bring up, is that the dollar has really had a significant bounce. And I meant to ask you guys about this too, just going back to the Federal Reserve, right? So Jerome Powell made a speech on Friday. It was relatively hawkish, right? He kind of walked back some of the stuff that some of the Fed presidents had said earlier in the week, talking about interest rate. He's like, it's way too early to discuss interest rates and all this, yet the market still rallied up. Like, I mean, we saw a beautiful rally on Friday, and my speculation was it's first of the month, new money flow coming in, from a lot of investors, and there's just this overreaching kind of bullishness. But is today now, are we seeing those comments actually be taken more seriously? Because you're right. I mean, Friday we saw markets up, dollar down, or mostly down, and then same thing with yields. But today it's the reverse. So, I mean, I guess it could be the risk premium, right, in terms of, like you mentioned, the attacks on the warships and on the ships. Or is it just that people are like, wait, maybe it is higher? Like, there's this battle, right? It's like higher for longer, but wait a minute, maybe not. Higher for, it's just back and forth. And so I mean, it's interesting because, again, the stock market is taking a beating today, except for the Russell. And there's money fleeing pretty quickly. I mean, these aren't small moves in some of these big cap, mega cap, $1 trillion names. I mean, Microsoft's down like 3%. That's not a small move on a $3 trillion market cap company.
I think one of the things that we've seen recently is a bull steepener in the yields. And in the short term, when we get a bull steepener, that's bullish for risk assets. And what I'm essentially referring to is, if you look at the 10-year yield, there is a case to be made, although I don't think it's certain yet, but there's a case to be made that it's put in a top that will last as a top for a little while. And if that's true, one of the things that we often see after the 10-year tops is we see risk assets go up, right? The 10-year topped here, risk assets went up. If you go back to prior cycles, you'll see that the 10-year topped in June of 2007. The S&P then topped a couple of months later. You go back to the dot-com crash, right? The 10-year tops were the S&P top. So my general view is that, we've potentially seen the 10-year top. There is a risk that we need to see the long end of the yield curve go to where the short end is, but I don't necessarily know if I believe that. And the market certainly doesn't believe that with pricing and rate cuts. But the thing I think that is relevant is, if you think back to a few months ago when the long end was going up, we had a bear steepener, right? Where the long end went from what, like 4% to 5% relatively quickly. That was super bearish for risk assets. It corresponded to the, to the typical pullback we get in the S&P in Q3 of pre-election years. But now look at this yield curve. If we move this back a few months, you can see that the short end here is relatively flat, right? This is back in July. Now look at it in September, still relatively flat. But then today you can see it's starting to fall off here. So markets are thinking that rate cuts are coming sometime in early 2024. And I think the reason they're thinking that is if you look at the labor market, it is showing a little weakness, right? I mean, we are getting pretty low on non-farm payroll. I believe last week was maybe the first week that I think not last week, last month, I don't think there was a single state that saw a lower unemployment rate. And normally that's not a good thing. So I think in the short term, you have long end yield curve down, risk assets go up. I think a lot of times when stocks rally after the 10-year tops, they can rally. The S&P can rally 20-25% even after that on average. And I think right now it's not even up that much. So it's still pretty typical late business cycle environment as far as I'm concerned. And as far as gold, I'm still in the macro bullish camp, right? I think it will likely go up even as rate cuts return, because when rate cuts occur and risk assets are high, right? Risk assets sell off, but gold usually just keeps on going higher.
A lot of sense, man. It's great insights there. So in terms of, non-farm payrolls this week on Friday, I think they're expecting somewhere in that 150,000 additional range. Are we in a consensus, I think, that you think the number will come in light, or are we going to continue to just kind of knock it out of the park? I know, Ben, you kind of mentioned that we're starting to see the weakness. I think continuing claims last week on last Thursday was a little higher than expected. But, I mean, do you have any insights on what investors are expecting? What are people expecting?
Well, the week-to-week fluctuations in the non-farm payrolls is less interesting to me because, people miss and get these things wrong all the time. The longer-term trend, like you guys mentioned already, is the weakness and the deteriorating strength of the labor market. So you're probably familiar with the Sohm rule, which is the rule that coined by Claudia Sohm, who is an economist with the Federal Reserve. And the rule is basically once the unemployment rate moves up by an average of 0.5% from the trough, a recession kicks in. I actually interviewed her about this, and she said that she fully expects the rule to be triggered, but she doesn't expect a recession to happen this year. Because of that, she thinks
this year, as in this year, or in 2024?
She expects the rule to be triggered in the sense that we will get at least a 0.5% increase on a 3-month average basis from the bottom of the unemployment rate, which is to say that it's going to go up to about at least 5%. It's at 4.9 right now, but she expects the rule to be broken for the first time in history.
Wow.
So the person who coined this rule, and this rule has never failed before, she fully expects, and she said this on air, that we're going to get above 5% unemployment, but that does not constitute a recession for this time around. This time is going to be different, she said. So
wow.
That's interesting.
Is this time ever really different, though, is the question.
I mean, she's the one that created this metric, right? So, I mean, she's like, if there's anyone that can call it, maybe that's it.
Maybe you guys can comment on this, but she was commenting on other indicators of the economy that still point to some resilience. Retail sales are still strong. People are not selling their homes yet. The housing market is still resilient. So, so this
is what and I know we're gonna end it in just 1 minute, but people are saying the housing market is resilient. All I see is price drops in my area down here in Florida. All I see is we had new home sales prices dropping 18% year over year. Then we talk about the resiliency of the consumer. Yes, I agree they're resilient, but at the same time they keep on using their credit cards to run up debt to be resilient. So it's just like, I mean, listen, who knows? We'll find out obviously in months or in the next year. But to me, it's like it's resilient, but it's like resilient on life support. That's just my 2 cents.
Ben, are you concerned about housing right now? We're just getting a little off topic from Bitcoin, but
the only thing I'd say about housing is, the existing homes are still doing pretty well. I think the only real concerning thing about housing, if you look at the sale price of new houses sold, that's actually dropping pretty quickly. And I think we might have just hit our peak drop percentage on this metric. Like new houses are actually year over year are lower now than they were during the financial crisis, in fact. But again, I think the reason is because existing homes, a lot of people, they don't want to move because they locked in a mortgage rate below 3%. So they don't want to move. But builders, they have to move inventory, right? And in order to move that inventory, you have to sometimes lower the price. And I do think that this is about as the biggest the year-over-year percentage change is going to get, negative 17.61. The reason is because if you look at this is October of 23, it peaked out in October of 22, right? So sort of the base effect is not going to be as bad moving forward. So I mean, the real estate market is likely slowing down, but I wouldn't say I anticipate a crash. I mean, if anything, it's going to be a slow grind for years until things become a bit more normal.
Have to get going. I know, Ben, you have to go to do a couple things, but I wanted to thank David Lin for coming in, man.
Thanks for having me here.
And Ben, my goal is everyone post comments. He needs to be in office here. I'm going to convince him to come down here so we can do a No Shill Zone in person. But thank you, Ben. Go check out Ben's socials, David, his stuff. All you guys know where to find these guys. They're awesome, and thank you for tuning in. Take care.
See you guys.
Have a good morning, everyone.